Planning for the what ifs. How to be ready for life's curveballs. I'm April Pope, certified financial planner and personal CFO. So, today we're going to talk about those things that you just don't really plan for, but as you know, if you've lived life a little bit, things just happen. So, we're going to call those curveballs. We know life doesn't always go according to plan, right? Does it? I don't think so. Maybe it's a job change or a health challenge or even a divorce. Sometimes it's just something good that just changes everything. Doesn't have to be bad. We can't predict every what if, but we can prepare our financial lives to handle them calmly, confidently, and with flexibility. So today we'll walk through how exactly to do that. So let me start with a story. A client of mine, we're going to call her Lisa, went through a divorce after more than 20 years of being married. She was organized, intentional, financially responsible, all the things. But when we reviewed her plan, we discovered her ex husband was still listed as the beneficiary on all of her retirement and life insurance accounts. So, if something would have happened to her, all of it would have gone straight to him and not to her kids. I'm sure he would have been great and given it to the kids, but you never know. I mean, maybe he wouldn't. I don't know. I don't know why she divorced him. But anyway, she had updated her will, but not those forms. And in that moment, she just realized, like, oh, it's just not enough to have a plan. You need to make sure your plan is aligned with your life and check and change it when things change. So, why does this matter? Most of us think of financial planning as making smart investments or saving for retirement. And yes, that is part of it and it's very important. But real financial confidence doesn't come from spreadsheets as much as I love spreadsheets. It comes from knowing that when life takes a sharp turn, your plan bends and flows with you. It doesn't break. So the what ifs aren't about fear, it's really just about readiness because I'm telling you, they're going to happen. Readiness comes from really having structure, not just luck of the draw when something happens that you can come up with a plan for it. So let's start with your foundation. Of course, your emergency fund. So when life changes suddenly, whether it's a job loss or an unexpected expense or a family emergency, having cash accessible is what buys you time and options. So that's why we always say 3 to 6 months of essential expenses and savings, a high yield savings account, money market account, something that's not going to fluctuate with the market. Accessibility is important, and you want to make sure there's no delays or penalties to get that money. Liquidity isn't just about those numbers, it's about making sure you have it when you need it. So, making sure you have your emergency fund. And then the next thing is preparing for estate and contingency planning. So, I want to talk about how decisions get made if you can't make them. So, every adult, no matter your age, if you're 18 or your income, you need at least a will, at least a financial power of attorney, and at least a healthcare proxy or living will, whatever your state calls it. These documents help ensure that your wishes are honored and that your loved ones are protected, and no one has to guess in the moment of a crisis. So, for many people, also a revocable living trust can be a smart addition as it can help you avoid probate and maintain privacy and all these things, and it allows a seamless transition if you become incapacitated or if you pass away unexpectedly. So these aren't documents for the wealthy. Let me say that. That's what I hear a lot. I don't have an estate. I don't need estate planning. You do. These are tools for anyone who values uh, clarity over chaos. Let's just put it that way. So that next, we're going to talk about strengthening that safety net. Think about your insurance or your risk management. So once your foundation's in order and your insurance, that just adds another level of protection. So think of it as like your safety valve. So disability insurance, that protects your paycheck. Life insurance, that protects your family. Long term care insurance, that protects your independence or how you want to live your life out in your last years or decades. Umbrella insurance, that protects your assets. So you're not insuring against fear, you're just insuring so that you have the freedom to recover and you can choose, what your next move will be when life takes those turns that you don't plan for. So the wake up call, it's really about the good details in a plan that's important. So think about when's the last time you checked whether the details of your plan still match your intentions and your goals. Most people don't realize that even the best financial plans can quietly unravel, not because of big mistakes, but just because of small oversight. So let's walk through three of the most common overlooked risks and the ones that we see most often in practice, even with smart, successful people. Number one, I already mentioned it with my client, Lisa. That's not her real name, but beneficiary designations. You need to know that whatever's on that paper overrides a will. So I don't care what you put in your will, if you didn't change your beneficiaries on your life insurance or on your retirement accounts, that's the legal document. Beneficiary forms override your will. So that means whoever is listed on that form or that life insurance policy, they're the ones getting the money, no matter what your will says. I've seen this mistake cost families thousands of dollars or worse, send assets to an ex or an outdated contact because no one thought to update the paperwork. So when your CFP asks during your review, can they see your beneficiaries? They're not being nosy. They're just making sure you did things because life happens and we get tired and we don't even remember if we did these things sometimes. So that's a simple thing you can do to make sure your plan is aligned with what you want. Number two, leaving money outright to your children. Okay, so just think if your child in the future were to go through a divorce or a lawsuit, would you want all the money that they inherited from you to go to your ex son or daughter in law? Or get wrapped up in some court case because they hit some plastic surgeon, they sued them for millions of dollars? I don't know. I probably would not want my inheritance going toward that. They can take all their money, but don't take what I was leaving for you and then eventually to my grandkids. So, a better option is maybe to use trusts and stage distributions and leaving assets in trust. There's a lot of information about that, but just knowing there is another way that you can do this instead of just putting your kids on beneficiaries of big life insurance policies or big retirement accounts and they get them at whenever 18, 25. You don't know what that could do to a 25-year-old inheriting millions of dollars or even hundreds of thousands of dollars. So, another thing to think about is when you add somebody, I see this a lot, and you have the joint tenancy with right of survivorship, is how you have your account set up. That survivor owns everything, even if your will says otherwise. This is one of the mistakes we see people unintentionally disinheriting their kids. So, what am I meaning by that? Let's say you get married, have wonderful kids, you end up getting divorced, you find somebody else, they have kids, happy Brady Bunch family, everybody's together. But then when if your accounts were titled that way and you had a bunch of stock from your company that was in your name and then you pass away, that's going to go to your spouse, your new spouse. And I'm sure he's the perfect person who's going to do the right thing. But what if he passes away? Who's his beneficiaries? Probably his kids if he hasn't updated it. So all of your stock could have gone to him and then to your kids, and you disinherit your own children. We don't want to do that. So make sure you have these account titling is important. Check with your CFP, check with your CPA, whoever your financial advisors are. Make sure those things are taken care of. So we really want to make sure we are ready. Make sure you have that cash accessible. Make sure the way that you have your documents are helping make sure your wishes are clear and what your loved ones, you're not just leaving them out there guessing. So it means your plan has been, reviewed. I don't say too often. I mean, at least annually, a couple every other year, like just check and make sure things are exactly how you want them to be. So if what if has been on your mind or maybe there's a form you're thinking about, should I have updated? This is the time. Go check it out. Do the one thing that you can do is maybe go check your beneficiaries at your current workplace plan. Just make sure those are right. Make sure you actually have them on there. That could be a one step that you do this week toward getting that done. So hopefully you found a tip that was helpful today. I'm April Pope, certified financial planner and personal CFO.